All right, we got a bunch of things to look at today. So you had your assignment. Your assignments should all be graded for chapters 14 and 15. If you have questions about it, email me. Let me know if you have questions about it. The solutions are posted. What I want to do today is, first of all, I want to go over the solutions to that last assignment briefly to kind of review what there was, what people had trouble with, and what we want to really remember from it for the final exam. But we're getting closer to the final exam now. So on these practice assignments especially, make sure you look at the multiple choice questions at the end. Use those to prepare for the final exam. I'll put a practice final exam up on the website soon also within another week or so. Anyway, what we only have a couple sections left, but the next section we're going to be looking at, chapter 16, for the next week and a half, about investment banking. The assignment for that's already posted at a practice assignment too, so you can start working on that, and we'll start looking at that stuff today. Investment banking brings together a whole bunch of different sort of random topics that don't always fit everywhere else, and that's kind of what the investment banking industry is. So it's going to tie together a lot of things that we've looked at already. And also investment banks, really they're institutions that connect very much back to the financial market. So it's going to it involves everything that we've looked at so far this semester come together with investment banking that we have next. First of all, let's look at the assignment that y'all just had that was due that we just graded. So the solutions are posted here. There were 2 articles that went along with it. And again, with this last section, these non-bank financial institutions, what's often called shadow banks or something like that. Again, these are big institutions. They generally provide financing in a way like they either make loans or they do something else that basically operates the same as loans. But for the most part, they're not technically banks because they don't take a lot of deposits. So they don't get regulated the same way. Because they don't get regulated like banks, whenever there's a crisis, sometimes they get a lot of criticism because whether it's true or not, they're perceived as basically getting kind of free pass because they get to do things that banks don't get to do, but they still can cause trouble like banks would. And sometimes that's true, sometimes it's not. Anyway, we looked at a bunch of these institutions. Also, in the U.S., it's quite different than it is elsewhere in the world. In the U.S., we have these historically very strict separations between banking and other activities. So a lot of these firms fell on the side of the non-bank other activities in the U.S., but in other countries, you generally got just giant universal institutions that do everything. So you can see that a little bit in the U.S. now because it's just started in the last decade, but elsewhere in the world you see big institutions doing everything. And on the practice assignment there, you had some examples with these. And one of these main types of institutions that we have here are insurance companies. So insurance companies are big financial institutions, technically not banks, but they do kind of operate parallel to the banking system in terms of providing financing, that is providing loans to a lot of firms out there. Okay, so on this assignment, first thing was reading one of these articles. There's a lot of stuff in the news. It's very current about these too big to fail institutions, which they call SIFI, or systemically important financial institutions. And so the first article here was to read about this. And in particular, there's one large firm called AIG, stands for American International Group. It was the largest insurance company in the U.S. a decade ago, but during the financial crisis of 2006 to 2008, this firm basically imploded dramatically. There was a massive taxpayer bailout. That was the main bailout of the whole financial crisis back from a decade ago. And we still kind of have repercussions from it now. It's still an issue in the presidential election right now. This firm AIG was one of the big ones. And so AIG now, it's only about half the size or less that it was a decade ago. But basically because it used to be so big, there's still a lot of talk from politicians to have it considered one of these systemically important institutions. And basically, if you get this label of being systemically important financial institution, either you're going to have to operate much more safely. You basically going to have to carry a lot of cash, like to keep in reserve, to basically have there to pay your debts if you need to. But holding all that cash is really unprofitable for a big firm. They lose a lot of money on that because they don't earn anything on the cash, so they don't like to do that. The other option is the Federal Reserve might choose to break up these big firms and basically force them to sell off divisions or to do spin-offs or something like that. So what the article was about is about 4 of these big non-bank financial institutions that are basically the Fed is considering sticking them with this label of being too big to fail or systemically important financial institutions. Some of the firms are resisting that in court. Some of the firms are basically responding to it preemptively by basically splitting themselves up and making themselves much smaller. AIG's already done that huge amount over the last decade because it was taken over by the taxpayers, actually. And it was split up already, and even what's left of it now is still splitting off more operations so that it can be smaller and safer. MetLife, the biggest existing insurance company, is basically fighting this whole process in court. Prudential is basically not doing anything, but it's basically hiding behind MetLife and trying to get whatever MetLife decides in court. Prudential is going to get the same benefit. And then GE, basically GE completely broke itself up. GE used to be a giant, of course, industrial firm, but it was also one of the nation's biggest banks based on how much financing it did. And in the last year, really, it's sold off pretty much all of its banking operations. So now it's purely an old-fashioned industrial company again, even though it used to be a giant bank, basically, a decade ago. So you get those four firms. They're all very, very important firms in the financial system in the U.S., AIG, MetLife, Prudential, and GE. At least they all used to be very important. MetLife and Prudential still are important. AIG is still somewhat important. GE is, as of this year, no longer important as a financial institution, but it's still a big industrial firm. The quotes for all of them, and actually, and I asked you for GE, overall, GE, because of the way it's listed, there's a bunch of sub-listings for it. The ticker, the quote you should have gotten was just for GE. A lot of you found one of the other sub-listings for it. I didn't take off any points if you got one of the sub-listings for it. Because it is kind of, that's what I want you to notice, it's complicated the way these firms are. Because they might have the parent company and they have a whole bunch of like financial subsidiaries that might be listed separately or differently. And that's one of the things I wanted you to notice about these. Now, for the most part, you're okay with number one, just identifying those four firms. Number two, the regulator that decides this whole sci-fi designation, it is the Federal Reserve. Technically, there's a committee that's drawn from the Federal Reserve, plus a couple other government officials, but the article still talked about this coming from the Fed. So the Fed is the main regulator that decides this whole process. And now number three, if you took basically the 2014 year-end total assets for these firms, and some of you got 2015, so you got maybe a point or two off. You got partial credit for it. As far as their size, this is what we had for it. MetLife is a little bit less than $1 trillion. So compared to the big banks, again, I had the number, I mentioned the wrong number for the big banks last time. Like JP Morgan Chase, the biggest bank, it's up at around $2 trillion. So this is half the size of the biggest bank. So it's not as big as the biggest banks, but it's still half the size. It's still pretty big. I mean, almost $1 trillion is big. Then you got Prudential a little bit behind them at about $766 billion. Now AIG is a lot smaller than what it used to be. It used to be up to around $1 trillion. Now it's $500 billion. And then if you took just the General Electric Capital Corporation, and if you look on their statement, if you go to their balance sheet, the first page of their balance sheet gives the whole GE Corporation with the industrial part plus the financial part. And then if you just go to the next page, it splits out the financial part separately. And the financial part has assets of about $493 billion. So you lost a couple points if you took the entire firm, but you still got most of the partial credit for it. So that's how big they are. And if you graph them, it's something like that. So GE and AIG, they're smaller. And again, MetLife and Prudential are kind of traditional life insurance companies. They're very conservative, old-fashioned. It's a very traditional industry life insurance, but they're quite large. AIG and GE are very different. They're not at all traditional insurance companies. AIG was really this kind of really weird, almost, it was a very unique firm. It basically sold insurance, but it was mostly dealing like financial type insurance. And financial insurance is essentially taking speculative trading positions. So it's almost like a giant hedge fund or a giant investment bank type of firm. And some of those contracts it made really are what went really bad in the financial crisis. So AIG is just a weird firm that's hard to classify. And then GE, again, is mostly providing kind of business financing, but in a very complicated way for all this business financing for the industrial products that it makes. So those are big players in the financial markets. They're very important firms, all of them, but you don't usually hear about them because they're not regular banks. Now, if you look at, then we took a subset of different firms, some of them from there and then a new one. So if we take AIG, another firm called Berkshire Hathaway, and MetLife, these are three firms that are, again, they're big, they're important, they are sort of insurance companies, more or less MetLife being purely an insurance company, AIG and Berkshire Hathaway being partial insurance companies. But these firms are important because these are major firms in this whole shadow banking industry. They do a lot of bank-like services, but technically they're not banks. So AIG, first of all, what we want to look at is just, if they're not banks, what are they actually doing? And to see what they're doing, if you look at just the items they have on their balance sheet, where they're getting their money, and then what they're doing with it, that's what the balance sheet shows. So I wanted to look at their balance sheet and see what are they doing with their money, where are they getting their money. So their assets is basically what they're doing, what they're investing their money in. For AIG, the first thing, they're investing in bonds. It's equivalent to making loans. So they're buying bonds out there in the bond market. So they got $250 billion worth of bonds that they own. So that is providing financing equivalent to making loans to firms. So they're operating like a big lender. Technically, they don't call them loans, they call them bonds because they're doing this privately with firms, but that's what they have. Then separately, they have these separate accounts managing money for clients. But again, almost all that separate account money is basically just going into buying bonds. So that's, again, more lending that they're managing for their clients. And then other invested assets, again, probably bonds and loans is what that is mostly. So what they're doing is they're providing financing. They're acting like a big lender out there. And if they were counted as a bank, this would be a pretty big sized loan portfolio here. So they're doing a lot of these bank-like services. But as far as where they're getting their money, as far as whether they're doing it like a bank, they have these policyholder contract deposits. So again, that's similar to what a bank does. Technically, these are not old-fashioned bank deposits. These are policyholder deposits, which means if you're a policyholder, you can't just go and ask for your money back like you can at a bank. You got to trigger an insurance claim somehow, whether it's a property insurance or some other type of insurance. You got to have a claim triggered. So it's like a bank deposit, but it's not exactly the same. So it's something similar, but not the same. Paid-in capital, that's equity, money contributed by the owners of the firm. And then separate accounts, again, money that's being managed on behalf of clients. Now, the one thing about the paid-in capital, these equity sources, traditional banks actually have very little equity. Traditional banks are the most highly levered firms out there in the economy. So the fact that these non-banks actually have these equity items, that is important. That actually is what makes them, on one hand, safer than banks. Again, one of the reasons banks are so risky for the economy is because they have very little equity, meaning when a bank loses money, they don't have to lose very much before they become insolvent, meaning they don't have enough assets to pay back their debts. With these firms, because they're not guaranteed in the same way a bank is, they're, on one hand, they're forced to be less risky by having more money contributed by their owners, and you can see that in that they have these equity items showing up as one of their main sources of funding. So AIG has this additional paid-in capital. Now, of course, most of that money provided by the owners was actually provided by the taxpayers who are partial owners of AIG due to the bailout that they got a couple of years ago. And if you take their loans to assets ratio, again, these are just kind of crude measures of this, and so it's pretty flexible. Most of you didn't have it exactly the way I asked, but you still all got partial credit for it. They only have a loans to assets ratio of about 6%, and that's kind of pure old-fashioned loans. If you counted all these other bonds that they're holding, then their loans to assets ratio would be much higher. They would have a pretty high ratio. So again, they're doing things like a bank, even though it's not exactly the same as a traditional bank. Now, Berkshire Hathaway, this is an interesting, unique firm out there. It's big, it's important. Its owner, a guy named Warren Buffett, one of the richest guys in the world. He's regularly cited all over in the media and the financial press. He's the Oracle of Omaha and all these other nicknames he has. He's very famous and very influential. He's likely to be in government sometime next year after the election or something. He might be next Treasury Secretary, something like that. We'll see. And what he has is, for his company, and it really is his company because it's almost like a privately held company, even though it's sort of public traded in a really weird, it's just a weird, unique company. Everything about it doesn't apply to other firms, but it's a big player in this, so it's important to look at. If you look at their asset side, their assets are nothing like a bank at all, really. Their assets are actually this weird mixture of stuff. The main item is equities. That's investing in the stock market. That makes them kind of like a hedge fund or a mutual fund or some kind of like investment trading company. It's not bank-like at all, but it is like a financial kind of financial activity. And then the other half is basically train tracks, the Burlington Northern Railway, the main railroad that goes through Dallas here, where all this other logistics shipping out of Dallas, that's all Berkshire Hathaway owns it all. They own that railroad and pretty much all the logistics stuff that's built around it, such as DFW Airport and everything else that this area is built on. The CEO of that half of the company, Matt Rose, he's very involved with UTA. He was here at Business Week the other week. He's one of the main speakers we had. He is an important connection for the university here, and his firm, they hire a lot of UTA graduates, so it's good to be aware of his firm and how they operate. And then the third thing, again, a financial asset, cash. So it's kind of a weird hybrid company. It's like one half is like a railroad, which is not financial at all. It's like a pure old-fashioned industry kind of. And then the other half is this kind of weird financial trading firm with a bunch of equities, which means it's investing in stocks of other companies, trading stocks. So it's not lending or buying bonds, but it's actually doing even more kind of risky financial activities. But if you look at their funding side, where they get their money, these items are all insurance items. They basically are funding themselves like an insurance company. So Berkshire Hathaway, what it is, it's basically one half is an insurance company. Their insurance division, they actually have a couple insurance divisions. The main one's called Geico, you've probably heard of. So that's their insurance half, where they raise a lot of money by selling insurance products. But then instead of just buying bonds with those, like a normal insurance company, they go out and they invest those in a range of different activities, half of which are building up Burlington Northern Railroad, and then the other half is investing in the stock market, all these equities they buy. So it's a weird combination, and a traditional bank would never be allowed to do anything like that. The regulators would never let it happen. But Berkshire Hathaway can get away with doing this because it's not a bank. It's a sort of insurance kind of company doing other stuff also. So you can see they have just a weird mix of activities that go there. And their loans to asset ratio is going to be a lot smaller because they're not actually providing loans all that much. They're investing in the stock market and running railroads. And then if we look at MetLife, this is, again, a more traditional insurance company. If we look at their assets, main thing is bonds. Fixed maturity securities, that means bonds. So they're lending money via the bond market. They got these separate accounts, again, basically managing other people's money and buying bonds. And then they have loans also, actual real mortgage loans, just like a bank would have. And then as far as where they're getting their money, they're managing other people's money as a financial institution, and then they got a bunch of insurance items, basically claims they have on their insurance policies. So it's pretty straightforward, and their loans to assets, as far as the pure loans, it's not too high compared to a bank, but if you counted those fixed maturity securities or separate accounts, it would be a lot higher. So what we see here is when you take these big shadow banks, they're doing a lot of financial activities and they're doing sort of a lot of lending, but not at all as straightforward as a regular bank. So this is what we have in the economy now, and these firms are really big. In the US and especially right now in China, the shadow banking system is really large. And it's hard to regulate because they're not banks. Like, how is a banking regulator supposed to regulate Berkshire Hathaway? They can just say they're a railroad. There's nothing like a bank. But they do have this financial side where they're doing a lot of financial activities. So as far as whether these firms either can or should be regulated like a bank, it's kind of one of those issues for regulators, and it's really hard to answer that or to respond to it. Okay, number 7 was going to the Fred database, getting these two series, and basically what you would get here is these finance companies, they don't have the same spread that a bank has. So a bank, they basically pay out money on deposits and then they earn money on loans, and the difference between that is how they make their money. These finance companies are going to have a different method of getting that. So the loans they make are a little bit different. They're making more kind of commercial and industrial loans rather than home mortgage loans. So it's basically get the rate that they earn on their loans and then take the rate that they pay. And the closest we could estimate to the rate they pay, the way they get money, would be issuing commercial paper. They got to issue debt to raise funds somehow. So if you take the difference between those two rates, you get this spread that they earn. And you can see that on the solutions there, and that's what they're earning. And that's how they make their money. So number 7 is really just getting an idea of what they do to make their money and what those kind of spreads have been historically. And then number 8 is this whole other side of the industry. So that's kind of the large-scale institutions, the shadow banking sector, the big insurance and then semi-insurance firms. And then number 8 is all these small-scale lenders, the ones that are not banks but are lending, not taking deposits, but basically lending on the small, kind of what we call the gray economy, where it's semi-legitimate and it crosses over into the either illegitimate or illegal side of this. And there's just a brand new regulator around the last couple of years, the Consumer Financial Protection Bureau, which is tasked with regulating these kind of consumer level lending services. And so one of the things that they're really trying to basically regulate a little bit is the payday lending industry, and that's what these articles were about. their regulatory powers, they come from the Dodd-Frank Wall Street Reform and Consumer Protection Act. That's the whole name of it. It's mentioned in the article. If I didn't have the article, I wouldn't expect you to know it, but it's mentioned right there in the article, so you should be able to see the name of it. And what they're regulating is consumer lending. Now, they're not regulating deposit taking. If it was actually taking deposits, then the FDIC would regulate those institutions like a bank. So these small-scale lenders, they don't officially take deposits, but they do make loans. And so basically, it's different proposals for cracking down on the payday lending industry. And all those proposals have kind of been stalled the last year or so because this CFPB is not fully staffed yet, not fully funded by Congress, because Congress is kind of resisting basically allowing this organization to operate. And it's really going to be not until after the next election that we see what happens with this whole CFPB here. And then the last article is basically what happened to General Electric. So General Electric, in response to these regulations, basically decided they're going to get rid of this whole lending arm, which basically based on how much lending GE was doing, they were the seventh biggest bank in the US in terms of their lending size, and they basically shut all that down just in the last couple of months. So it's a massive amount of lending, the seventh biggest bank to just be shut down like this and sold off. So the main chunk of their lending operations, they've sold to Wells Fargo. So Wells Fargo took over a lot of this. The regulator of GE Capital is actually, it was the Office of Thrift Supervision. So GE basically bought one of these little savings and loans or thrifts years ago and basically used them officially as the kind of legal license they had to do this lending operations. And actually they took some deposits through that. But they're actually regulated like a thrift, which is weird. You have this giant industrial company operating the seventh biggest bank, but being lended as if it was some little credit union or something is how they were being regulated. It didn't make any sense, so it kind of made sense that something had to be done about all that, and it was, and now it's all shut down. So the institution that is now the regulator is the Federal Reserve, although now since they basically shut it down, they took over, but now it's all sold off to Wells Fargo anyway, so it doesn't really make a difference now. They would have been the seventh biggest bank, is where they ranked in terms of the amount of loans they had. And then GE, because they weren't a bank, they didn't have to follow the bank's rules. So they didn't even compute or report like the net interest margin, which is one of the main measures of profitability that a normal bank would report. And GE didn't mess with it or report it. Probably because even though they made these loans, they didn't really raise funds by deposits. So they couldn't really calculate it the same as a normal bank would. And that's what made it hard to judge if GE was safe or risky or what they were doing, because you can't analyze them like you would a normal bank. So that's what you should have had for everything there. Any questions about that assignment? Okay, everybody can look at that stuff then. What we have for the next assignment, let me show you what we got here, a little preview of it. So investment banking, we have a practice assignment. There is an article there, as well as the assignment and solutions. We can look at that briefly. And then there is the regular assignment along with an article there from the Wall Street Journal that mentions it. And let me show you what we have there, what you have for the next week and a half. So here, once again, we're going to take a couple firms and we're going to analyze what's on their statements to see what they're doing actually, to get an idea of some of these real world firms, what activities they're actually doing, to see what they do, and especially now relative to these shadow banks and traditional banks that we've looked at, to kind of compare them. So you've got 4 firms here, and what we want to do is we want to take the year-end 2014 values. Now I was trying to be specific here, so year-end 2014 values, you can get those either from the 2014 annual report or the 2015 annual report, because they usually list 2 years of values. So you can get either one of those reports, whichever one you get, just make sure the values you report on your assignment are the year-end 2014 values. That's what I want to have for the assignment. It's probably easiest if you just get the 2014 annual report, because it'll be easiest just to line it up. It'll be the main item there. Although if you choose to use the 2015 annual report, you can. It'll be a little bit harder because it won't be the last column. It'll be the second last column. But it'll still give the same numbers in there, as long as you take them for the right year. And so what we're going to do is we want to use the revenue section. So you just need the revenue section. And so that's going to be from the income statement. Make sure you use the parent company or the bank holding company, not a subsidiary. And use thousands of US dollars for all firms, because here again, we want to compare these firms. So we want to see how big they are relative to each other. So if you take one firm in millions and the other firm in thousands, then one firm's going to look 1,000 times bigger than the other firm when it shouldn't be. We want to compare them accurately. And if you get answers like that, then you're doing it wrong. If one firm is like 1,000 times bigger than the other when it shouldn't be. Now, these firms aren't the same size. Basically, two of these firms are big. Goldman and UBS are very big firms. Goldman is generally considered sort of one of the most traditional, well-known, respected, or hated, however it is, investment banks in the world in the U.S. They are known as the investment bank of Wall Street and everything. So they're going to have a lot of that. Now, UBS is another one of these large global European universal banks. So it's a big bank. It's also a big investment bank. It's a big asset manager. It does everything, as a lot of these big European institutions do, but that includes doing a lot of investment banking. So we want to compare those firms. And then we have two smaller specialized firms. E-Trade is a much smaller firm from the U.S. It markets itself as kind of a new modern internet brokerage firm. And when you look at the assignment, we'll see how true that actually is by looking at their numbers. And then Lazard is a smaller investment bank. So the investment banking industries we talk about, you got big firms and you got small specialized firms. And we'll look at their statements to see what they actually do and how true their kind of image actually matches what they actually do. So I give a very detailed items here of exactly what I want you to look at what they have there and classify it into different investment banking activities. And I specify exactly what items I want for each firm. So to take those items, put them in Excel, and then basically compare these firms. Basically make graphs to compare how these firms compare to each other for these different items that they have. That's most of what you have here for this. For UBS, since it's a European firm, get an exchange rate quote from the internet, convert everything to US dollars. That's something you should just be aware of in general. If you want to compare a foreign firm, you've got to convert it to dollars. And I give you these tables here just to fill in these tables with the numbers then. So there should be no room for flexibility there. Just take the numbers from their statements and fill in these tables with it then. And then from those, the rest of the items are really just to take some of those numbers and graph them so that you can visibly just compare how these different firms rank in terms of size for different items. So that's what you have here for the most part. And then number 11 and 12, there's another one of these articles here. There's basically a big change in regulation just in the last week, actually in the last month. But we have some questions about that and an article about that. So read that article and answer these questions about it there. Okay, so that's what we got there for the next assignment. We ask questions about it next time after you have time to look at it and start working on it. All right, so what we got now? Where's my pen? Investment banking. Investment banking is a fun industry because it's generally considered a little bit more exciting than a lot of the other parts of the financial system. Part of that because of the nature of the industry. It's mostly a service industry. Investment banks don't have a lot of assets of their own. They tend to be much smaller institutions than, say, a big bank, because most of what they do is they provide services to other firms, which means a lot of their value is not in assets that they have, but it's in the employees that they have. And since their employees are very valuable, they care a lot about paying well, training their employees well, and their reputation. That's why it's kind of exciting to work for these firms, because they're much more into their human capital than their actual financial capital. So it makes them kind of interesting and exciting a little bit. It also makes them mysterious and hard to measure, hard to regulate, unless they make good bad guys whenever something goes wrong. So they're both interesting and they're both hated at the same time, just by the nature of what they do. There's no one definition of what an investment bank is or what they do. They kind of do everything else that a regular traditional bank doesn't do. Our book especially kind of shows us that they lump a whole bunch of different firms together in this chapter of investment banking. And many of these firms that are included in chapter 16, normally you would never call any of these firms an investment bank, but our chapter lumps them all together. So basically, if everything that's not a traditional bank is called an investment bank, according to our book, which isn't really all that realistic. But there's not really a better definition for it, maybe. So basically, according to our book, they basically define investment banks as firms that do anything else other than commercial banking, which is like a whole wide range of stuff, including just what we just had in chapter 14 and 15. Insurance would be something other than commercial banking, so they kind of would count as investment banks according to our book, but people would never call MetLife an investment bank really, so it's a bit vague the way it's defined here. So another way to look at it, maybe to look at what all these other kind of financial activities are that our book kind of considers to be investment banking. There's a lot of different ways you can kind of categorize financial activities. We might call it, first of all, financial services might be like in the overall vaguest, broadest kind of term for all these different financial activities. And then under financial services, you got a couple other things. You got commercial banking. You got insurance. And then you'd have investment banking. So you kind of think of it as being like, these are the three kind of most broad categories, but they overlap a lot. So if you talk about lending, all of these firms might do lending, but only commercial banks take deposits. Now the actual activities of investment banks, probably 5 different things here. On one hand, I won't number them yet, you got traditional investment banking. And traditional investment banking has probably a couple parts to it. And not all sources would really separate them as being 2 separate things, because they overlap a lot. You can't really have one without the other all that much. But it would be advising and underwriting. And these are the kind of the 2 activities that we would traditionally call investment banking. And in order to be called an investment bank, you'd have to do these 2 activities, or one or the other. And as far as one or the other, again, they merge into each other. Sometimes it's hard to say if it's advising or underwriting, or it's both. Sometimes they're distinct, but usually they appear very similar from the outside. So they might just be one activity. We call it advising and underwriting. Sometimes, though, you can kind of separate them out as being 2 different things. But this is really what traditional investment banking is. And we'll come back in the rest of this week and next. We're going to be looking in much more detail at these activities. So that'd be kind of one side of investment banking. And then the other side is probably more what we would call investing rather than investment banking. Now, a lot of investment banks, they do both investment banking and they do investing. And so, again, the distinction is going to be subtle sometimes, and we'll be talking about that for the next couple of classes. Now, investing, I would split it into 3 kind of components. You got asset management, you got brokerage, and you got trading. They're all very similar, and they're all very similar to what we looked at in chapters 17 and 18 with the whole institutional investing, mutual funds, all that stuff. It's basically the same thing with that. Investment banks do a lot of that also. So the distinction here, asset management is basically investing other people's money. That's what asset management would be. Brokerage is very similar, but a subtle difference. Brokerage would be helping other people to invest their money. So you're not investing it, but you're helping them to invest it. Maybe giving them advice or setting them up, connecting them to the stock market, giving them a website, giving them research. You're not actually investing it, but you're helping other people to invest. With asset management, you actually invest other people's money, such as by running a mutual fund, running a pension fund, running separate accounts for an insurance company. All that would be asset management. And then trading, very similar, but here you're using your own money. It's just investing your own money would be trading. So these three investing activities, they're very similar. It's just the distinction whether you're using your own money or somebody else's money, and whether you're making the decisions or whether you're helping somebody else to make the decisions. So sometimes people just lump all that together as investing. And generally the thing with investing, if you're working with somebody else's money, you charge fees for it. If you're investing your own money, then you get whatever profits you make by investing your own money. So there's a distinction whether you're earning fees or whether you're making profits on trading. Now with traditional investment banking, you're not necessarily investing at all, but you're helping basically to create new securities. So you're advising firms on new securities to issue, and then underwriting is actually helping them to issue those securities. So these kind of 5 activities, these would be sort of the activities that fall under the category of investment banking here in Chapter 13. So we look at all the different financial services out there. With commercial banking, you got taking deposits, and you got lending. That would be kind of the 2 activities that a traditional commercial bank does. A traditional insurance firm, basically they write insurance policies, so they insure. So you got that. And then investment banks do a whole range of different stuff. And really, traditional investment banks do advising and underwriting. And then you got all sorts of other financial firms that do investing. There's a lot of firms that do investing only, and you would not call them an investment bank if they just do brokerage or they just do asset management. Like for asset management, we already looked at a bunch of firms basically run mutual funds, and we call those investment advisors or mutual fund firms or asset managers. We don't call them investment banks. So if you talk about like Vanguard or Fidelity or BlackRock, those firms we looked at before, they would all be in this asset management category, but you wouldn't call them an investment bank, even though in this chapter they kind of fit in investment banking because they do asset management. Fidelity and Vanguard are also, they're very big brokerage firms. They do a lot of brokerage, but we don't call them investment banks. And they're not called investment banks because they don't do advising and underwriting for the most part. And then a lot of investing firms like hedge funds, they exist to do trading. They do a lot of trading. So again, they'd be down here on this investment side, but they don't do underwriting and advising. So again, we don't call them investment banks. Okay, so again, if we put these into 5 categories, so you get those kind of 5 categories. With these, only the first 2 kind of being traditional investment banking, and then these other ones being kind of more what I would just call investing rather than investment banking. And so those other 3, you can do those. You'd be called an investment firm or some kind of investment company, but you wouldn't be called an investment bank if you did just asset management, brokerage, and trading. To be an investment bank, you got to do the underwriting and advising. Any questions about all that? We'll talk about that more all week. Next week, this week, a lot of times. So there can be lots more questions later. Okay, to understand these activities and the whole investment banking industry, it'll help to review the history of investment banking in the U.S. Just briefly, because the industry is very specific and it's got its own unique history, and that kind of explains a lot of the structure of it and how they work and what they do and what the main firms are. And a lot of it's this other side of the regulation. So we kept talking with commercial banks that in the U.S. historically there's been all this regulation on banking that basically separated commercial banking from investment banking and basically served to keep U.S. banks relatively small, both in terms of size, where they could operate and what they could do. Same thing applied for investment banks in the U.S. To a large extent. And then everywhere else in the world, you get these giant universal banks that do everything. So in the rest of the world, you don't really have like an investment banking industry as much as you do in the U.S. because you just got big commercial banks. And those big commercial banks, because commercial banking is so big, most of the big banks in other countries, they'll be 70% a giant commercial bank, and then 30% of their activities will be investment banking. So you don't have giant standalone investment banks. But in the U.S., historically, investment banking was separate from commercial banking. We had this whole Glass-Steagall Act and a couple other laws. So you had these giant commercial banks on one hand, and then you had big investment banks that were kind of standalone investment banks. So you had these big firms that were very specialized just on investment banking. And because they specialized on investment banking, they were very good at it. And so even though they weren't as big as the universal banks elsewhere in the world, because they didn't have their giant commercial banking side, because they specialized in investment banking and they were so good at it, they really came to dominate investment banking worldwide. So you get these U.S. kind of pure investment banks that have dominated this industry worldwide for most of the past century. And so they kind of are these unique U.S. firms, and that's why the U.S. kind of dominates this industry in a way. And also the U.S. has the most developed financial markets. Again, we have very developed stock markets and bond markets in the U.S., which are basically run by investment banks. And because of that, we don't need big commercial banks because firms can issue bonds instead of getting loans. And it might be the cause and effect there is reversed, that the reason we have such developed financial markets is because we have these big specialized investment banks, and that's why we don't need to have big commercial banks. So there's kind of a whole cause and effect that might be mixed up there. In the rest of the world, you got big commercial banks, so you don't need big financial markets, you don't need big bond markets, you don't need big investment banks, or maybe because the commercial banks dominate everything, it kind of strangles the investment banking industry elsewhere in the world because firms just depend on bank loans and they don't use bond markets and stuff. So what happened is you had commercial banks and investment banking separate. So investment banking was separate from commercial banking. And this really kind of applied through much of the history of the U.S., but especially from 1930s up to the 1990s. So especially for that 60-year period, this separation was fairly strict. And then it started to be relaxed in the 1990s, and it's really only in the last couple of years, the last decade, that it really got relaxed. And then since the financial crisis of 2008, everything's changed. So this is kind of how it was for most of the past century or so. And so what the U.S. had is the U.S. had the big five. There were 5 big investment banks, and they dominated investment banking worldwide. And you could say because of them, the U.S. had these giant developed financial markets, or the U.S. had these 5 big firms because we had giant developed financial markets. Again, you can't really separate which one was the cause and which was the effect. You got to have both of them going together. But there were these 5 big investment banks, and they were really pure investment banks. They didn't do commercial banking at all because of the way that was separate in the U.S. So everywhere else in the world, you had big commercial banks that did investment banking, but here you had 5 big investment banks. And they were Merrill Lynch, Goldman Sachs, Morgan Stanley, Bear Stearns. You had those 5 firms. And so they dominated investment banking both in the US and worldwide. Especially, let's say, from the 1930s up until 2006 or 2007. These firms dominated the industry. One of the interesting about them is most of them actually, even though they dominated investment banking in Wall Street, like many of these other big financial firms, they were themselves not publicly traded corporations. They were actually usually private partnerships or some type of mutual co-op, kind of semi-charitable almost institution. It was only in the 1990s really that they converted to be for-profit corporations and they issued stocks. So that's kind of one of the weird things about them. But that applies also for a lot of these other large financial institutions that we've seen. So you had those 5 firms that dominated this investment banking industry. And then what happened is starting in the 1990s, again, the rules were kind of relaxed on them. They were allowed to mix with commercial banks a bit. And at first they didn't happen too much, but basically in 2008, when we had the whole, starting in 2006, when this financial crisis happened, a lot of the financial crisis, the real problem with it is you had real estate values go down a little bit. Some banks lost a little bit of money on that, but not too much. It wasn't really a big problem. But the problem was some of these investment banks were making contracts through AIG, the big insurance company, with some of the big commercial banks. And those contracts were tied to the value of home mortgages. And when those values started to go down, some of these investment banks basically got into trouble. Now, they weren't regulated like a bank, so they actually didn't have to carry a lot of cash reserves or anything like that. And basically, 2 of them, Bear Stearns and Lehman Brothers, basically didn't have enough money to pay out on some of their contracts that they'd entered into. And when they started to lose money, basically, they were facing not so much that they were insolvent, but they had temporary cash flow problems, which did result in them defaulting on some of the debts that they owned. And so they went bankrupt, would be the legal term for it. And when that happened, it shut down the whole financial system, and that's what caused this whole giant financial crisis that we had almost a decade ago. So what happened is these 5 firms that just had dominated finance worldwide for close to a century, within a couple weeks really, in 2000, well I guess over 2 years, from 2006 to 2008, they all were either wiped out or transformed. So it was like a huge transformation of the financial system that happened here. And basically the first one, Bear Stearns, they went bankrupt, and that's really was the prelude to the whole financial crisis. Most of what was left over from them, it was absorbed. So J.P. Morgan absorbed a lot of what was left, which is kind of what transformed J.P. Morgan from being more of an old-fashioned commercial bank into starting to be an investment bank, have an investment bank / commercial bank. Then Lehman Brothers also was the main one that failed. And when Lehman Brothers failed, that's what really triggered the real financial crisis. It was the failure of Lehman Brothers that just kind of ended the financial world as we knew it back in 2008. That was the real trigger for the serious bad stuff in the system, is that Lehman Brothers failed. After Lehman Brothers failed, next in line was Merrill Lynch. Merrill Lynch had kind of been traditionally the biggest and strongest of these firms, but it faced failure next, and then it was basically absorbed by Bank of America. So Bank of America, which before that, actually Bank of America had been a fairly small, boring North Carolina bank called Nations Bank, and then suddenly in the early 2000s it merged with a whole bunch of other banks and became this national giant bank, but they were still a giant commercial bank. But then by absorbing Merrill Lynch, which had been the largest investment bank pretty much in the world, Bank of America got a giant investment banking unit. So after this process, basically the pieces of Lehman Brothers and Bear Stearns were both kind of taken over by J.P. Morgan. So J.P. Morgan went from being a commercial bank to a commercial bank / investment bank. Bank of America absorbed Merrill Lynch, so it became a commercial bank / investment bank. So this is kind of how the commercial banks and investment banks merged together after all this time of being separate. And then the last two, Goldman Sachs and Morgan Stanley, they survived, but technically, they converted to be technically commercial banks in the financial crisis. And they didn't actually want to do that. They wanted to maintain their independence as old-fashioned investment banks. But the Federal Reserve, basically thinking the world was about to end back in 2008, wanted to bail out all the firms, whether they wanted to bail out or not. But the Federal Reserve is only allowed to bail out commercial banks. So in order to force Goldman Sachs and Morgan Stanley to get a bailout, which they actually didn't want, it forced them to say they were commercial banks, to convert to be commercial banks. And once they were commercial banks, then the Fed could bail them out. So it's like a really weird, almost perverse kind of circumstances that happened. It's just a crazy story how it was with all that. So Goldman Sachs and Morgan Stanley were basically forced to take some deposits, and once they took deposits, they were officially commercial banks, and then they could get Federal Reserve bailouts, which is what happened in 2008. And because the whole thing was perverse and messed up, that's why we have, again, Bernie Sanders basically running on what a disaster all this was, and basing a presidential campaign on sort of the repercussions from it that are still felt. Even though they were never real commercial banks, they were always investment banks. And Goldman Sachs and Morgan Stanley, they kind of survived as investment banks. And so after this, these 5 firms that kind of dominated forever kind of are gone as far as how the structure was for the past century. And so now, it's kind of drastically different. So now if you look at the top U.S. investment banks, we got still you still got Goldman Sachs and Morgan Stanley. Technically, they're semi-commercial banks, but they're 99% investment bank, 1% commercial bank. So they're technically regulated as commercial banks now, but they're still mostly investment banks. So you got them, and then you also got, now you got BOA is Bank of America / Merrill Lynch, JP Morgan Chase, and then another firm which had been really a large, really one of the U.S.'s only large merchant banks. It didn't really run a large retail operation as far as taking customer deposits. It mostly took business deposits and serviced big multinational businesses that wanted to have offices kind of around the world. But it does a lot of investment banking also, so now it would be kind of an investment bank. So we still got kind of 5 big firms, but they're not exactly the same as what they were for the past century. It's kind of been transformed. And with these, the last 3, also being big commercial banks. So you got only 2 firms that are left, Goldman Sachs and Morgan Stanley, that are kind of pure investment banks, that are big and dominant. And then you got Bank of America, JP Morgan Chase, and to a lesser extent this firm Citigroup, that are big commercial banks and big investment banks. So they do a bit of both. And so it's very different, and it's kind of weird the mix that you have then, especially with Bank of America and JP Morgan Chase being, I mean, those are the 2 biggest commercial banks, but they're also now big investment banks. And so the regulators don't really know how to deal with them. Do you regulate them like a commercial bank and keep them really safe? Or do you let them be an investment bank, which inherently means they got to take on risk by operating in the financial markets? If you want the financial markets to be big and successful and useful, then you got to have these big firms basically doing risky activities in them, because that's what drives the functioning of the financial markets. And so I think kind of as a society or an economy and regulation, we don't know how to treat these big firms, especially in the U.S. where we're not used to having big universal banks. So JP Morgan Chase, Bank of America, Citigroup, they're really like big universal banks like traditionally we've had in Europe and Asia and elsewhere. And then mixed with them, we got Goldman Sachs and Morgan Stanley, which are kind of the old-fashioned pure investment banks. And so that's what it looks like now as far as how the industry is. And so a lot of our assignment is to look at some of these firms, and they each have a very different mix of what they do. Some of them, like Bank of America, Merrill Lynch is really a lot smaller than it used to be. Bank of America is really purely a commercial bank. Merrill Lynch, even though it's an investment bank, it's more of a brokerage firm. It does a lot of brokerage, which means just connecting other people to the markets. JP Morgan Chase is definitely a big commercial bank, And then it's also a big investment bank that does a lot of underwriting and advising. Citigroup is really a big merchant bank, and then it also does investment banking, underwriting, and advising. Morgan Stanley is pretty much a traditional investment bank. Goldman Sachs, as we look at it, is really not so much a traditional investment bank, but it's more like a giant hedge fund. It does a lot of trading activity. So it's not so much doing advising and underwriting, but it's doing a lot of high-risk trading. So it's actually almost a different kind of firm. And so you see like a different mix between what these firms actually do and how they kind of fit together with the whole system here. And that's kind of what we want to get a feel for with some of this. Questions about that so far? And again, a lot of what the, and then if you lump these all together, the one firm that's kind of missing here, like this list here, these would count as sort of the 5 biggest banks in the U.S. But then another firm, which is actually number 3 biggest bank, which is not on this, is this one, Wells Fargo. And Wells Fargo is not here because even though it's the second or third biggest bank, depending how you measure it, they don't do any investment banking. They're a pure big commercial bank. So Wells Fargo didn't pick up the pieces of any of those investment banks that failed in the crisis. They stayed far, far away from that, and because of that, they're actually really successful. They didn't get in trouble in the financial crisis because they didn't do any of the crazy financial engineering and investment banking to get all the other firms in trouble. They kind of stayed boring and safe, and because of that, they came through as the strongest firm. And even though now they face some trouble sometimes, they're still pretty much they're the only big pure commercial bank that we have left in this country, really, or worldwide. They're probably the world's biggest pure commercial bank that doesn't do a whole lot of investment banking. So that's kind of the story of the structure of what we have here, as far as the big firms. No questions about it? Okay, the other side of the industry. So those are the giant firms. So there's also a whole bunch of small specialized investment banks. And these small specialized ones, they're called boutiques. So if you see the term boutique in terms of financial service firms, what we mean is a small specialized investment bank. And again, to be called an investment bank, you really got to do advising and underwriting. So if you're a small firm, you're probably not going to get and do all 5 of those activities: advising, underwriting, brokerage, asset management, trading. You're probably just going to focus on one of those things. So a small firm that focuses, say, on only advising or only underwriting, we would call that a boutique investment bank. If you're a small firm and you focus just on trading, we'd call you basically a small trading firm, but we wouldn't call you an investment bank then, because you got to do underwriting or advising to be called an investment bank. Now, most of these small firms, it's hard to get information on them because mostly they're going to be organized either as partnerships or privately held firms, not for-profit corporations. So it's hard to actually go and look at their financials because if you're not a for-profit corporation, again, you don't have to file your financial statements, you don't have to file income statements, balance sheets, any of these other disclosures. You don't have a stock price out there. You basically can keep everything secret, and that's what most of these firms actually are. So it's kind of hard to see them, but there are a couple that you can get information on. So there's a couple examples that you can actually go out and observe that you might have heard. There's one called Cohen. There's one called Rothschild. There's one called Lazard. Those are 3 of the most well-known or famous of these boutique investment banks, Cohen, Rothschild, and Lazard, that are actually publicly traded, so you can actually get their statements and look at what they do and see sort of some of the information about them. And one of them is on our practice assignment, the other one's on our real assignment. So looking at some of those ones is one of the things that we have to do there. questions about it? Now, again, just to compare this, the U.S. industry is really, again, unique because we have this separation of commercial and investment banking. So we have these giant standalone investment banks that really got very specialized and dominated the industry. Most elsewhere in the world, most countries have just one or two universal banks that dominate that country's financial system. And again, because they're universal banks, they're usually like 70, 80% commercial bank, and only a small part of their operations is investment bank, so they don't really depend on investment banking nearly as much as these large U.S. firms. And some of the names we'll look at as we go through the assignments, so you should know some of them, and they all have a different mix of what they do. So in the UK, you got Barclays, and HSBC would be the two big ones, with HSBC being only sort of a Hong Kong / Singapore / UK firm. And we'll look at these as we go. As we go, we'll mention a lot of these firms. You'll see them mentioned again. And one thing about investment banking, again, that I'll come back to, that I mentioned before, if you look at what they do, they're mostly service firms. So if we go back, so some of these firms, UK has Barclays and Hong Kong Shanghai Banking Corporation. That's what HSBC stands for. France has BNP Paribas, which is their big investment bank. They also have Society General, which is sort of an investment bank, more a commercial bank. Germany has Deutsche Bank. Switzerland has UBS, Union Bank of Switzerland, and also one called Credit Suisse. So they're two big investment banking firms. But again, all these firms that are listed here are mostly commercial banks that do some investment banking. So it's kind of hard to call any of them investment banks because they're mostly commercial banks. But if we go back to the 5 activities that investment banks do, I want to again point out. So these 5 activities: advising, underwriting, asset management, brokerage, and trading. From an accounting viewpoint, and to understand again how the industry works in a way, none of these require very many assets. They're all service things. Like when I talk about traditional banking, that is taking deposits, making loans, that involves a lot of actual assets. All those deposits you get, that's money that's owned by the bank then, and then they make those loans, and those loans are assets that they own. So they have giant balance sheets. They have a lot of assets that those firms own. If you talk about insurance, all that money that comes in as policies, that's all owed back by the insurance company. It's all invested in bonds. So it all shows up on the balance sheet, either as separate accounts or as bonds or as policy reserves or something. So you have very large firms. But if you look at investment banking, to do advising, you don't actually have to have, you don't take deposits and put them on your balance sheet. You don't owe anybody money to do advising. You don't have any big assets like loans or anything else. All you got is you got some people giving advice. So it doesn't actually show up as your firm being like any bigger. I mean, you can do a ton of advising, but your balance sheet might be tiny because it doesn't require any assets. The same with underwriting. When you underwrite, what I mean is issuing securities, but it's not really the investment bank that's issuing securities, it's their client firm. So if you are Walmart and you want to issue a bunch of stock, you hire Goldman Sachs to basically advise you on how to issue that stock, but it's still Walmart that's issuing the stock. So if it shows up on a balance sheet, it's all going to be on Walmart's balance sheet as far as issuing stock and getting all the money from it. Goldman just gives advice on it and then collects some fees. So it doesn't show up on Walmart's balance sheet as any big activity. When you do asset management, again, you're managing somebody else's money. So you're getting a fee for it by running a mutual fund or something, but all that money actually belongs to the client. It's not to the firm doing the asset management. So again, it doesn't necessarily show up on your balance sheet. The same with brokerage. When you're doing brokerage, you're helping other people to connect to the stock market, but it's the other people's money that's being invested. So it doesn't show up as your assets or liabilities. So again, it doesn't show up on your balance sheet. So the first four activities here, they don't require any kind of size for the firm in terms of assets and liabilities. So investment banks, it's really hard to measure how big the firm is or how much of something they're doing because it's all other people's money. Only the trading side of it at the end is their own money. So trading shows up on your balance sheet. If you do trading, that's your own money. That shows up on your statements as kind of a measure of size. But everything else is other people's money that you're dealing with. You're advising or underwriting or managing or providing brokerage services for other people's money. Because of that, again, banks don't have a lot of assets. So most of what you're doing is you're providing services to manage other people's money. So all this is not really reflected on the balance sheet of the investment bank. You don't really see it showing up because it's other people's money, not the investment bank's money. And because of this, since investment banks are not really investing in their own assets, most of their value so whenever I say investment bank, I need to stop writing it out. It's just going to be IV for investment bank. So most of the value of investment banks, it's in these kind of fuzzy, abstract concepts like human capital. It's basically the talent of their employees, because their employees are the ones providing these services. They're not providing these services because they have a giant vault full of assets or gold or something that they're investing. They're investing other people's money, so they're just their employees giving that advice. And if their employees are convincing and exciting and talented, then they can do that really well. If not, then nobody's going to pay for their advice. They got a lot of intellectual property. They got their employees' secret formulas, ideas, all their data they collect, stuff like that. That's where their value is in this kind of, not physical assets, but this kind of intellectual property and information that they have and they control. And a lot of that's reflected, since it's not reflected in how big they are in terms of how much money they have, because it's not their money, it's really their reputation that matters. And you'll see reputation in investment banking is everything, and a lot of what they do is based on reflections of their reputation. So since they got these kind of things here, this is why it's kind of an exciting industry. Since it's all about human capital, intellectual property, and reputation, they're very concerned with things like paying their employees really, really well, because they want to have, either they want to have the best people, and even if they don't have the best people, they want to make it look like they have the best people. So they want to pay them the most, so that everybody will think they have the cleverest people, so then they'll hire them for advice. Even if the people are idiots, if they pay them enough, other people might think that they're really smart. And so that's sometimes they get in this game. They compete with each other to see who can pay the most, so that it'll impress their clients, so their clients will think they got to hire those people because they must be smart because they get paid so much. So some of that leads to, it makes it really exciting to work for them, and then it also can make them really look like horrible, bad people when you get all these crazy pay packages on Wall Street where they get paid so much and they seem to be doing just an utter failure at their job. All that comes into the investment banking industry because of these kind of motivations that they get. So, and then really, there's no easy way to judge that or correct for it. What else can you do about it? And we'll see as we look at this reputation, a lot of it gets into then advertising and stuff like that. They'll advertise, and a lot of even the way they do their something that normally would be really boring, their SEC filings, the paperwork that they got to submit to the SEC for registration statements, for security filings. they can make a super big deal about something that nobody else would care about. So if you look at the font size that they use on their SEC filings, it's like super important. And the bigger font you use to list your name as an investment bank when you underwrite a security, it means the better reputation you have in terms of how much you can get paid. And so you go into those filings and you can see which bank is listed first and how big the font is that they use, whether it's 12 point or 14 point. And there's this whole pecking order of who's allowed to use what font size. And then it's like they're super concerned. And it determines all this stuff about who gets paid what and who gets to whatever, sit next to whoever on the next meeting and all this other stuff, and who gets the big $1 million bonus and who doesn't. It's kind of crazy and weird, but there's this whole subculture that goes along with it. And you can see that in the filings, and so we'll look at that a bit. And you can see by the font size which banks have the big reputation and which banks are less recognized and less reputable and don't get to charge as much then. And so there's a lot of this weird stuff that goes on with it. And actually, this is a good place to stop for now, because what I want to look at next is to go into more detail, and basically we'll have the next two classes, is to go into a lot more detail on each of those 5 activities that they do here. And so we'll look at those in a lot more detail as we go now through the next part. Any questions about it though before we stop? So you get the next assignment. You can work on it. You should have a lot of stuff to start with it. And it's basically just going through those statements for some of these investment banks here, and we'll be looking at that as we go. It's where I used to work back before I went to grad school. All right, I'll see you next time.
I was going to ask you, you seem to know about
Oh, okay.
Sorry,
Yeah.
summer, I was wondering if you had
I know, whatever you learn there is going to be great. Yeah,